Coming up in this episode, NVIDIA's stock takes a hit despite record-breaking earnings. Microsoft's rumored data center cancellations spark big questions, and the Fed's next move on interest rates remains uncertain. Plus, is the U.S. economy really growing, or is government spending masking a private sector recession? And if you're new to investing, we break down ETFs, mutual funds, and equity indexes so you can make smarter financial decisions. Stay tuned. Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Farian. He's the CEO and founder of Flying V, our digital marketing partner. Rob, so glad we are now only 3 time zones apart. How are you doing?
It feels, I don't know, I feel a renewed energy, Gary, having you back. Welcome back, first and foremost.
Thank you.
I know you were all over the place, but yeah, it's good having you back home. Nice to have you here, both logistically. We've been having some good success with the content over the last few weeks, but hopefully this is even another catalyst to where, for whatever reason, just doing the show here in the States, we're really dialed in. But wanted to ask you, tell us about, I don't know, anything, favorite moments throughout your travels, any good takeaways?
I think the thing I enjoyed the most, and look, I always love Thailand, but I hadn't been to Vietnam in over 20 years. And I made the trip. I spent a lot of time in Ho Chi Minh City, formerly Saigon, and then made the trip north to Da Nang, where I had the opportunity to go surfing. The waves there were great. I think I told you this. I had a really good surfing instructor from Sweden, and we just had a great time there. So it was nice. It was nice to be back in Vietnam. And then I had a chance to visit Korea, which was a first for me. And somehow it was colder there than here. And, but I did not have the right cold weather gear. So, at least now I'm home and warm in the cold.
There you go. Good stuff.
Yeah.
Gary, well, welcome back. We're glad to have you. Thanks so much for still keeping the 5 things going. I know travel's tough and long trips that you were making, but we're all glad to have you back. This week's version of the 5 things is the public recession issue. We're talking NVIDIA, Microsoft, PCE, GDP, and also talking ETFs, mutual funds, the whole 9 yards there in our investor education portion of the show. Gary, ready to jump right into it with thing number 1. We're talking huge NVIDIA earnings, but they don't keep the stock safe. Also talking about DeepSeek. You're going to mention that here in a minute. Thing number 1, Gary, we're talking NVIDIA, Q4 earnings report.
All right, Rob. So NVIDIA just posted another blockbuster quarter, 78% sales growth and 80% higher profits, yet the stock dropped. Why? Has AI demand peaked, or is DeepSeek's unexpected computing needs reshaping the industry? Today, we're unpacking what's really going on with NVIDIA stock and the future of AI infrastructure. So, Rob, here's what happened. The company actually reported a really good quarter. The growth was enormous. Total revenue up 78%, net income up 80%. And remember, this is a company that has posted huge growth numbers for a couple of years in a row. The new Blackwell AI chips are selling well, and their projections for first quarter sales of $43 billion was above analyst expectations. So that beat, plus optimistic projections, put on hold for now the speculation that DeepSeek would alleviate the need for AI data centers. However, the stock absolutely fell apart. It went from, I think it was 135 in the middle of the week down to 124 by the end of the week, and then sold down to 114. And today, we're filming this on Monday sell-off. The stock's been priced for perfection. And with annual sales of over $200 billion expected this year, NVIDIA's growth rate has to slow. And that growth rate is falling from over 100% to suppose that they're expecting to have mid 50% growth this year. Still a great number, but this is a stock that just has been priced for perfection, and it was going to take a monster quarter for them to keep their, what had been their current stock price. Instead, what we got was a great quarter, and it wasn't enough to keep the stock up.
So it sounds like great results coming out of NVIDIA. I mean, is DeepSeek, or how much of a problem are they going to be for NVIDIA?
So, Rob, I think that's the great question. And that's the thing the market has been focused on for the last month. And what's really interesting was NVIDIA CEO Jensen Huang address this. So previously, Deep Knowledge Investing, we have come out saying that there are no shortcuts in AI. And we noted, a month ago that DeepSeek's model requires less upfront resources and training, but it's at the expense of higher back-end computing and energy usage. So, you pick up value early on, but then you get bled for each query that, each time you have to search the model. And so Jensen Huang came out and he said that reasoning models like DeepSeek's use 100 times more computing resources. Now, I don't know how he's calculating that. He tends to be a pretty exacting guy. The only thing I can tell you on this is whether it's, 10 times as much or 50 times as much or 100 times as much as CEO Jensen Huang said, this is just not a situation where DeepSeek is going to enable the large language learning models to avoid using, NVIDIA's best GPUs. They're going to keep selling for a while.
Yeah, NVIDIA locked in there for a long time. Gary, moving to thing number 2, we're looking at Microsoft and some rumors out there about canceling leases, looking at will others kind of follow trend. Gary, thing number 2, we're talking about data centers, Microsoft data center rumor. Thing number 2, Gary.
Rob, rumors are swirling that Microsoft is canceling massive data center leases, 700 megawatts worth. Is this a warning sign that the AI boom is cooling down, or is Microsoft just shifting strategies? Today, we're unpacking what's really going on and whether other companies should follow their lead. So, Rob, what happened here is Microsoft they've said all our plans are the same, they're all fine. But snuck in the back of an analyst report a week ago was a rumor that the company has canceled multiple leases with data centers in the United States. Those leases have a combined 700 megawatts of capacity. That's a big number. And so a lot of investors were taking that as a sign that the data center market is oversupplied and, everybody's trying to jettison out. Now, what's really interesting about it is the company claims they're not canceling leases and that they've planned over $80 billion in infrastructure investments. So there are a couple of possibilities here. One is it was just a rumor and the, research firm got it wrong. And that happens with sell-side research. It happens with everybody. Everybody gets something wrong at some point. But if there are lease cancellations, it could mean a couple of things. It could mean that Microsoft is saying, we want to have less exposure to the space and we want to get out. It could also mean that they're going to pivot toward building and owning more of their own data centers, which would be a bullish statement, right? If you want to build it and own it rather than lease it. So we're not sure at this point what it is that Microsoft's doing, but the information that's out right now is contradictory.
Gary, curious on your thoughts just personally. I mean, do you think Microsoft is reducing AI spending? If they are, why do you think so? What's your take here?
Yeah, I don't think they are. Now, let's be clear. We don't know at this point. I don't have anybody in the C-suite of Microsoft reporting back, right? And even if we did, it would be illegal to talk about it. So, we don't have that contact. And so the answer is I don't know. The reason I'm skeptical about Microsoft reducing AI spending is it was just a few weeks ago that they came out and talked about increasing AI spending by tens of billions of dollars this year. The other hyperscalers companies like Amazon and Google are also spending more. We just got NVIDIA's results. And again, this is a company where we saw a growth rate of 100% going to 80%. They're still expecting growth this year to be in the mid 50, 55, 56%. So everybody is saying we're spending more, and the company that they're spending this on is saying we're getting orders. People want to buy what we're selling. We just saw an order for Dell. It was for tens of billions of dollars of their servers with the NVIDIA GPUs in them. So what we're seeing from all over the industry is that spending is increasing. So I don't think it's likely that Microsoft is scaling back. But if they are, they're telling the market one thing and then quietly doing something else to get out. There is one thing that concerns me, though. And this is something, Rob, that we've talked about for the last year on this show. It's that a lot of the companies spending tens of billions of dollars on AI don't have a business plan to earn a return on that investment. They're not sure how they're going to make that money. There really aren't, consumer products out there. Yeah, you could pay, what is it, $30 a month to buy Microsoft's premium version of Copilot. I don't think people are lining up for that yet. Could it become something to justify all that spending in the future? Maybe, but it's not there now. And so we think as more companies offer AI models, the pricing of whatever emerges is likely to fall as well. And I don't think anybody's cutting spending yet, but there is an open question that we've had on how are they going to earn a return on that spending.
Yeah, I could not agree more, Gary. And I think it'll play itself out. Obviously, you got a bunch of applications, widgets too in the AI space, using all those wrappers as well. So it'll be interesting to see how they monetize AI moving forward. Again, this is the 5 things with deep knowledge investing. We're breaking down everything you need to know in investing for this week. Please head over to our website, deepknowledgeinvesting.com. You can sign up for a free subscription to be added to our newsletter. That'll give you alerts on new content and information that's coming out on the website. Please know, though, that not all of that content will be available to free subscribers. We have plenty of content that's gated for our premium subscribers, $100 per month for a premium subscription. That will get you access to all gated content, speaker opportunities, current recommendations, as well as most importantly, when Gary is selling and exiting positions. So be sure to head over to our website at deepknowledgeinvesting.com. Gary, moving on to thing number 3, we're talking PCE, personal consumption expenditures. We see them falling. And Gary, one of the questions you're going to answer, what do we think this means for the Fed? Thing number 3, Gary, we're rolling into fresh PCE numbers.
Inflation is cooling, but not enough. The latest PCE numbers show a slight drop, yet the Fed isn't budging on rate cuts. With consumer spending shifting and no major progress toward the 2% target, what's next for interest rates? Today, we're breaking it all down. So, Rob, the PCE stands for the Personal Consumption Expenditures Index. It's the preferred inflation gauge that the Federal Reserve tracks. And the reason they focus on that one is it tracks the prices of goods and services bought by a typical household. It most closely reflects people's actual inflation experience, which, nobody has the exact inflation experience of the CPI, the Consumer Price Index. So because it reflects the consumer experience, that's why the Federal Reserve focuses on it. And so the PCE for last month showed a year-over-year increase of 2.5% in January. It was down 0.1% from last month. The core PCE number, that excludes food and energy, came down to 2.6% year over year. That was also in line with expectations. But the key thing here, Rob, is there has been almost no progress on any kind of disinflation, let alone deflation, over the past year. And it's also important to note that while the January PCE was below the December reading, their monthly change was up 0.3%. And again, that doesn't sound like a big number, but it annualizes to 3.7%. And so, when we look at that, it's just very clear the Fed is not making the progress they hope to.
So, Gary, we're seeing the PCE falling. Going back to what I mentioned, the Fed, what does that mean for the Federal Reserve?
I think what it means is they're going to stay on pause. There's going to be no new inflation data coming out between now and the next Fed meeting. And so barring something really strange happening in the next, few weeks, we expect the Federal Reserve is going to keep the Fed funds rate exactly where it is right now. Inflation is too high for them to keep lowering rates. But, as we'll talk about later in the show, the private market economy is really struggling. And I think raising rates is going to be rough for people right now. So I think the Fed is going to pause. That is the consensus opinion right now. For the horrible inflation that we all experienced in 22, 23, the first half of 24, that was a situation where DKI had a different view than the market. And we were saying higher for longer when people were screaming for rate cuts. But everybody isn't wrong all the time. And right now, I agree with consensus. The Fed is going to stay pat where they are right now.
Keep you in tune with any Fed movement as we track the macro level through DKI's 5 things and any move that the Fed makes over the next couple of months. Gary, moving to GDP now, we're seeing more growth. I know in the past we've talked about GDP growth being tied to government spending. I'm sure somewhere we're getting conversation about a bifurcated economy as well. Yeah. Gary, moving to thing number 4, GDP growth is misleading.
All right, Rob. GDP is growing, but not for the reasons you think. Last quarter's 2.3% growth was entirely fueled by government spending, while the private economy continues to shrink. Is the U.S. heading for a hidden recession, and will new economic policies change course? Today, we're unpacking what's really going on behind the numbers. So, Rob, last week, we got a fourth quarter GDP announcement with growth of 2.3%. That was down from the prior quarter's 3.1%, but in line with expectations. So, the question here, like, is that good? Is that bad? 2.3% growth. It's not great. It's not bad. It certainly isn't big enough to cause the Fed to alter its current policy. So that's what we were talking about before. If this were a situation where, inflation was up a bit, that will prevent the Fed from lowering rates. But if we had bigger GDP growth, they'd be safer raising rates, but they're not. 2.3% isn't enough to cause the Fed to say, okay, we need to raise rates. This is also a situation, again, you talked about a bifurcated economy. Declines in consumer spending and investment were offset by higher government spending. And then, the other thing we saw was a continued trend for lower goods prices, but higher services prices.
Gary, 2.3% GDP, right? If we're just looking at that number, not a bad number. I think we talked about it a little bit with the bifurcated economy. Is that why you're not more optimistic on the economy? Because essentially we're seeing two different things here between public and private.
Yeah, I think the whole GDP number is faked. It is just absolute nonsense. So to give you a sense, Rob, in the quarter, the increase in GDP was under $400 billion. The increase in government debt, and this is just the on-balance sheet number, was over $600 billion. In other words, more than 100% of the increase in GDP came from debt-fueled government spending. And, one of the things that we've been tracking is, everybody's focused on DOGE, right? The Department of Government Efficiency. And what they're finding is that there are staggering levels of government fraud. It's just, I've always been a small government, small spending guy, but even the levels of fraud here have shocked me. And so right now, economists are facing a crazy situation. So on one hand, it's clearly in the best interest of the country to eliminate as much fraud, theft, waste, and money laundering as possible in the U.S. government, right? None of that adds to the quality of our lives. It's just theft, and it should be stopped. Here's the issue that economists are facing. As we cut that spending and wasteful employment, technically, we're going to enter a recession, right? Because that government spending not only contributes to GDP, it's all of GDP growth. We've got a situation where cutting the waste, which needs to be done, and that waste is not creating value for any of us, it will make it look like we have negative growth. Now, technically, according to the equation, according to the formula, that's true. But, again, this is like, the analogy I could give you would be, Rob, imagine we take our credit cards, we go to the candy store, we buy huge amounts of candy, then we throw that candy in the garbage, and we tell people that because we spent more, our income is up.
Right.
It just, the whole thing makes no sense. It needs to stop, and they're trying to get it down. But until that happens, as that happens, we are going to see cuts in government spending, which is going to lower GDP or the calculation of GDP. And obviously, the employment reports are going to take a gigantic hit. By the way, have you seen the number of houses on sale in the Washington, D.C. and Northern Virginia markets?
I've heard.
Yeah.
I'm a little bit far removed from that market, but it's made its way to the West Coast too. Yeah.
Yeah. And people there, like, there are Google searches up for like defense attorneys, extradition. Like, people are worried about being extradited from other countries. It's just like the combination of houses being put on the market and insane Google searches that people are doing is really something to watch.
Gary, I have a follow-up actually just in relation to what you were talking about, okay, with that cut in spending and then technically sending us into a technical recession. I'm assuming that's just an indicator to the layman or even the economists, right? I think at this point that are looking at this GDP number, seeing negative growth. And then, what does that do to equities when in reality, this is actually solving a huge problem? I mean, will we start to see declines in the Dow and the big indexes just based on this GDP and information once this happens?
Yeah, so that's really the R's go to 11 question for everybody who's a fan of This Is Spinal Tap. The question is, what is it that matters? Reality or the thing you're using to measure reality, right? And so cutting government spending, cutting wasteful government spending, cutting theft and money laundering and fraud, that's a great thing. And it will make GDP go down, but that's just the thing that you're measuring. If you are in the private economy, if you're not in the business of stealing from government, right? Anything that reduces the load that government is placing on the private economy is going to be a good thing. So cutting this kind of spending will actually be good for the dollar. It'll be good for bringing down interest rates, right? All of that theft leads to increases in the money supply. That leads to inflation, and that leads to higher interest rates. So reversing that will actually be better for the people in the private economy, but Wall Street will, of course, freak out about, the thing that you're measuring. And so, it's are you focused on reality or the thing you use to measure reality?
Yeah, makes sense. Thanks for clarifying that, Gary. Again, this is this week's version of the 5 things. Please head to deepknowledgeinvesting.com. You can grab a free subscription to be updated on our new issue that drops every single week. Keeps you in tune with everything you need to know about investing. This week's version is called the Public Recession Issue. Again, be sure to add your list to our email subscribers. Also consider a premium subscription for full access to the website. And if anything, please subscribe to us on YouTube. Send us a like, leave us a comment, question, tell us we're good, tell us we're bad. If we're bad, though, Gary, what's the rule? Let us know why, or
Just
why
tell
you
us
think
why.
we aren't very smart, right? Which is perfectly fine.
Yeah.
Perfectly fine. Gary, moving to the 5th thing, we're talking, again, investor education and knowledge. Today, we're talking ETFs, mutual funds, as well as equity indexes. So, Gary, I'm going to break those up. We're going to start with mutual funds. And Gary, I want to know, tell us more about mutual funds. What are they? Why should you care about them as an investor?
ETFs, mutual funds, equity indexes, what do they really mean and how do they impact your investments? If you've ever been confused by these terms, you're not alone. Today, we're breaking it all down so you can invest smarter and with confidence. All right, Rob. So let's start with mutual funds. A mutual fund is simply a vehicle that pools investors' money, and then the fund managers will invest that money according to something called a prospectus. The prospectus is the legal document that explains to people we are going to invest in certain things. So some mutual funds will invest in stocks, others in bonds, others in domestic companies, others in foreign companies. Some will invest in large cap or small cap stocks, or sometimes there are specific industries. So you might have like a technology mutual fund, which will invest in companies like we were talking about earlier, like NVIDIA or Google or Microsoft. You might have a mutual fund that invests in energy or energy production. Really any kind of industry or different way of breaking things up. But what you're doing is you're investing with a company, and then the fund manager will invest that money for you within the bounds of what's described in the prospectus.
Gary, mutual funds charge a management fee. Just curious, how can an investor know, or where should they even look in terms of this management fee? And then how are they being managed too? Actively, passively? How much work's actually being done in these funds?
It depends. So in general, first of all, the management fee has to be disclosed. You can find that in the prospectus. You can find it on the company website. Like if you look up the particular fund, you go to their website, it will tell you how much they charge. This is information that's disclosed very clearly. And, when you're looking at investing, the company will send you the prospectus. Now, someone might say, hey, listen, I don't want to read 100 pages of legalese. That's fine. You don't have to. I understand why somebody, if you're looking at 10 mutual funds, you might not want to read 1,000 pages written by attorneys. I get that. What you can do in that situation is just read the description of the fund, the kinds of things they're going to invest in. And then if you take a look, the fee structure there will be prominently disclosed. It's not the kind of thing that they can hide. In the past, almost all mutual funds were actively managed. And what that means is that there is a fund manager who exercises discretion. There are more funds now, more mutual funds now that are passively managed, which means they're designed to track a certain index or a certain sector index. And their goal is just to maintain certain weightings and try to make sure they match market pricing.
Gary, moving to ETFs, want to talk about those. Gary, tell us more. What are ETFs? And then how you approach investing in ETFs.
So ETF stands for Exchange Traded Fund. Basically, we can make this one really simple. Take everything that we just said about mutual funds. So a mutual fund, you're simply investing in a pooled vehicle where a fund manager will invest that money for you according to what they tell you they're going to do in a particular sector or in stocks or in bonds, domestic, foreign, market cap, right? So ETFs are basically the same thing. The only difference is instead of calling the fund company and, sending them a check or wiring money in or, dealing with them directly, you can buy these funds like they're individual stocks on an exchange. So with a lot of them, you can go into your brokerage account and just put in the ticker of that fund and you can buy it and sell it at any point throughout the trading day. They often have lower fees and, increased liquidity. So for some people, that'll be a good thing. For others, if you overtrade, it's probably a bad thing. But what it does is it takes everything that people like about mutual funds and makes it easier to buy and sell them and easier to track them instead of having a bunch of individual investments where you get separate statements every quarter. You just see everything in your brokerage account. It just makes things a little more flexible and easier for people.
Yeah, I think that's the big thing there. More flexible investing option. Gary, final piece, this week's 5 things. Tell us about equity indexes. What are they? Everything we might need to know about that to wrap up the show.
All right, let's give examples of what those are. An equity index, the big 3, and there are a bunch of them, but the big ones that people tend to track are the Dow Jones Industrial Average, the S&P 500, and the NASDAQ 100. And what these are benchmarks that track the performance of groups of companies. And there are all kinds of issues with the way they do these things, Rob. So one of the reasons why the Dow Jones Industrial Average isn't particularly useful is for whatever ridiculous reason, mostly history and lack of computers a couple hundred years ago when the index was established, it is price weighted. And so what that means is that a stock with a high price has a greater weighting in the index than a stock with a low price. But the stock with the low price might have a much larger market cap. Now, if you look at the S&P 500 or the NASDAQ, those indexes are market cap weighted, and that's a much more sensible way to do things, except we've got a situation right now where, the top 7 companies are something, like a third of the index, or maybe a little less than that right now, given today's, tech blow up. But the point of all this is the equity indexes can be an interesting way to track market performance. They're benchmarks. They're something to look at to get a sense of what the market in general is doing. I would just point out that whatever methodology people are using is always questionable. These are just sort of benchmarks, something you can keep an eye on, but it's not necessarily, actual investment performance. Now, the one thing people can do is these equity indexes are not investment products. However, there are passively managed ETFs. We were just talking about exchange traded funds that are designed to track the performance of those indexes. So, you can't go to Standard & Poor's and say, I want to buy the S&P 500 index, but there are ETFs that will come very close to matching the performance of that same thing with the NASDAQ. And so you basically, for the NASDAQ, it's QQQ. For the S&P 500, they're called spiders. That ticker is I. Dow Jones, they're called diamonds. But basically, you can buy investment products that will track the indexes if that's something you'd like to do.
Great stuff, Gary. Thanks for breaking all of that down for us between ETFs, mutual funds, and equity indexes. That concludes this week's version of the 5 Things. Thanks so much for everyone that watched and tuned in. Again, be sure to subscribe to our YouTube channel. Give us a like, comment, good, bad, indifferent. Let us know. We'd love to hear from you. You can also head to our website and use the Ask Gary feature. Any question that you might have, that'll go directly to Gary, and you may even see your question end up on the show. Thanks so much for joining us. Again, be sure to head to deepknowledgeinvesting.com, sign up for that free subscription. And Gary, I'm going to turn it over to you for the final thoughts.
Well, first, round of applause for Josh Reeves, DKI intern from the University of Tennessee. He did great work on this week's issue. A lot of what you're seeing and hearing, their contributions made by Josh. He's doing a fantastic job. And, the University of Tennessee, their business program, they're turning out phenomenal students. Rob, I also want to thank you and the Flying V team. It was not easy. When I was in Thailand and Vietnam, that's a 12-hour time difference, 15 to you. And then, in Korea, that's another 2 hours. So 14-hour time difference from New York. It's 17 hours away from you. We were filming at all kinds of weird hours for everybody. And, also round of applause for Nazim the Dream, who's been doing a great job with our YouTube videos. So, it's fun to come on and be the one who gets to talk about this stuff. But in the end, there are a lot of people supporting me and helping and contributing their work. And so it's really important to acknowledge all of them. Looking forward later this week to other events coming up. I'm going to be on with Marty Bent on his show. He's invited me on to talk about Bitcoin and some of the disagreements that I have with Nassim Taleb's assertion that Bitcoin is worth zero. I disagree with Taleb. We'll be talking about that. Looking forward to being on with Marty. And then DKI's other intern, Finley Rowland, we are going to be filming our first episode of DKI Foundations, and we're going to be talking about getting started in your career, about investment basics, about, some of the lessons that we've picked up along the way. We'll be bringing in other former DKI interns who have succeeded extremely well. They've done phenomenally well. Yes. So we'll be bringing them on to talk about how they've done well. I think, if you're a novice investor or you're a young person interested in having a good career, come check it out. I think I've seen the outlines that Finley's produced. She's doing terrific work. We're really excited by what she's doing. And then finally, to everyone watching this, thank you. We know your time is valuable. Thank you for spending it with us. Josh and I already have most of next week's 5 things mapped out. The big issues have already presented themselves on Monday. We've had a whole week, as of just the beginning of the week. So we are looking forward to coming to you guys in a week with more great content. Thanks so much.
Thanks, everyone.